Hello, investors. Thank you for joining me. My name is Michael from Deep Value Returns and Seeking Alpha. Today, I want to talk about Lightspeed Commerce. So, Lightspeed Commerce is a commerce platform that helps suppliers and merchants connect up and have payment tools. So, it's really a way for essentially restaurants to be able to manage their commerce side of the business. As you'll see, this business is I know it's not really worthwhile investing. And I know that there's a short thesis on it, but even like after that, I think that it's difficult to get behind this business. So if you look here, last a year ago, I said that Lightspeed is growing fast, but its valuation is already pricing in a substantial amount of hope. I'm not convinced that the company's organic growth rates are likely to support its valuation. And in the investment game, being too early is the same as being wrong. So, I made this claim and I just kind of watched it go, and it was kind of going up and up and up and up and up every single day. And I just kept on looking at this and thinking to myself, man, like, what is everyone else seeing that I'm not seeing? And then the short thesis came out, and then like in a few weeks, this kind of tumbled 40%. And so let's unpick what's left here. Okay, so um, Lightspeed is clearly growing its revenues at a very rapid rate. Okay, that's not there's no denying that. The problem is that the bulk of it, even we're told that more than half of the revenues coming in Q2 2022 are inorganic. So remember, the fiscal year and calendar year are misaligned. I'm just referring to the fiscal year. Okay, and so we're told that it's mostly inorganic. So just for one reference point, okay. So we are told that subscriptions and transactions revenues were up 203% year over year, but of that, the organic portion coming from subscription revenues was only up 58% year over year. So you're kind of like, oh, okay, so what's going on here? So they kind of went through the call and spent a lot of time talking about the short thesis, and they highlight, yes, we are very much acquisitive, but that's part of our strategy to gain scale. Okay, now something that I wanted to highlight. So what Lightspeed does is really aimed predominantly at like restaurants and golf courses, but it's predominantly aimed at restaurants. So they sell you hardware, and it's a kind of like Block, formerly known as Square, that they kind of ship you out the terminal, and then they kind of charge fees on top of that. So it's similar to that. The difference here is that in the case of Lightspeed, they have a subscription business attached to that hardware. Now, for Q2 2022, the subscription side of the business only accounts for 44% of the overall business. What's more, they talk about on the SEC filing that the transaction part of the business, which is lower margin, is going to represent an increasing portion of our overall revenue mix over time. So with that in mind, the portion that is attractive is going to be dwindling. So it's kind of like, yeah, it's difficult to get behind this investment. Now, uh, do profits matter? So I put out this question. So for this is what I reported in my previous article. So I showed in the previous article that uh, the business is having, so they're deploying 256 million for acquisitions, but that's not leading to a proportional increase of cash flow from operating activities. You can see that the cash flows were negative 93 million compared to negative 29 million in the previous year. So despite using a lot of capital to buy any acquisitions, those acquisitions haven't really translated into a bump in cash flow from operations. Now, for the 6 months ending in September 21, so for H1 2022, we're looking here and you can see here. So they've deployed nearly 400 million towards acquisitions, but that's actually seen the cash flow from operations go from negative 15 million in the same period a year ago to negative 28 million this time around. So again, it's the same thing. They're deploying capital and they're not really seeing that proportional. So this is just for the 6 months. It doesn't cover the whole year, but you can see it for all intents and purposes. They're just buying businesses as they go. Now, just one more thing I wanted before discussing this valuation. So you can see here for the 3 months ended in September 21, and then compared to the previous year. So you can see here the number of shares outstanding increased by 46% year over year from 95 million in the previous year to 139 million this time around. Okay, so there's as as the revenue growth rates increase, the number of total shares outstanding also are up 46% year over year. So that's quite substantial. So if you're a shareholder in this business and you feel yourself, hey, I'm getting diluted by 36% in a year, man, that's really, really aggressive. And then uh, the day after the quarter ends, they talk about their newest acquisition, Ecwig or Ecwig, I don't know how to pronounce that, or Ecwid, I don't know. So that they diluted shareholders by a further 5 million there. And so it implies that kind of year over year for them to grow their organic, for reference rate, to them to grow their organic side of the business by 58% year over year, you're seeing the total number of shares outstanding increasing by 55% year over year. So, I mean, it's kind of like for like. You kind of, I don't know, with all that in mind, I don't know if it's really worthwhile paying 9 times forward sales for this business. I've just put up a Buffett quote that says that somebody once said that if you're looking for people to hire, you should look for three qualities: integrity, intelligence, and energy. And if you don't have the first, the other two will kill you. And I'm not, for the sake of, I'm not being Captain Hindsight. I know that I didn't particularly call this investment absolutely right, but there was enough evidence at the time last year for me to say that this wasn't worthwhile investing. And now this obviously brings up the natural question, which is it worthwhile investing in right now? And my question to that is like, why? There are so many really high quality businesses right now that have based just fallen so substantially in the recent sell-off. Like it's really a buyer's market. You can just like pick and choose. You don't have to kind of play the hero here because long shots, they become no shots. Anyway, hope you found this useful. This is not investment advice, it's just for entertainment purposes. But if you want to find out what kind of stocks I'm interested in, don't forget to check out my marketplace called Deep Value Returns. I help you think through investing. You can check out what other people said in my platform. That's always a good way for you to start your due diligence. Okay, thanks for listening. Bye bye.